Okay, good evening, everybody. You're welcome to our financial reporting class for ICANN. Someone just confirm you can hear me before we continue? Okay, thank you so much. Sorry for the confirmation. We are going to continue from where we stopped the last time. If you can recall, we already started discussion on IAS20, accounting for government grants and disclosure of government assistance, right? And I've done all the background information. So all we need to do is to, solve questions around that. So I'm going to use a question, sorry, to demonstrate what IAS20 is all about. Then so that we can quickly move to IAS23, and then we can have time to take a look at IAS16 and the likes. Okay, so we said the last time that when it comes to government grants, an assistance by government in form of transfer of resources in compliance with past or future conditions relating to operating activity of an entity. Okay, so the basic thing is when it comes to government grants, it only requires a condition and transfer resources. Resources, it could be money or assets. And if it is money, that's grant related to income. And if it is assets or money was released to buy an asset, then you call it grant related to assets or capital grant. And I also told you how to account for government grants. So you can recall we said there are two methods that are going to apply when dealing with accounting for government grants. For grant related to income, the first method is you treat it as part of other income. And the second method is you deduct the grant from the cost of the related expense and debit the balance into the income statement. Then for grant related to assets, all you need to do is to set up a deferred income and spread over the life of the asset. That's method one. And method two is to deduct the cost of the grant from the from the cost of the asset, deduct the grant from the cost of the asset, and then spread the balance over the life of that asset. So I'm going to use the question to, demonstrate that, and hopefully we're going to get the gist around the standard. So I've actually done a lot of what's it called? A lot of explanation in the last lecture. Okay, so we have this question before us. So let's quickly take a look at that so that we can move very quickly. Sorry. In many countries of the world, government provides financial assistance to the industry in form of grants. In accordance with IAS20, accounting for government grants and disclosure of government assistance. Explain the term grant related to assets and grant related to income. So I believe you should be able to do that. Okay. Then let's move on. You now say Prospect Nigeria PLC obtained a grant of 100 million from federal government of Nigeria for an investment project to construct a plant costing 880 million. Now, if you look at that, it was the federal government that gives Prospect Nigeria, a grant of 100 million because there's a construction of a project that will cost around 880 million. So when you see information like that, then you start thinking about IAS20. Meanwhile, you needed to be sure that there is a condition attached to it because most likely government will never give any entity anything for free. Okay, so apart from that, how will I know that this is grant related to income or grant related to assets? So if you see here, it said investment project to construct a plant. So obviously this is grant related to assets. Okay, so that's how to determine that. But grant related to income is always very straightforward. There's no much accounting issue around that. Now say the principal term of the grant are as follows. That's the conditions. Can you see that? Grant payment. Okay. Grant payment to be made subject to attaining minimum level of plant expenditure. The secondary intention is to the grant is to safeguard 500 jobs. The grant will have to repay pro rata if there is an underspending of capital. 20% of the grant will have to be paid if the jobs are not safeguarded until 18th month after the date of the cost of capital expenditure. Prospect Nigeria PLC completed the construction of the plant on 1st January 2013 with a total cost of 900 million. Okay, so initially they estimated 880 million, but they actually completed it by spending 900 million. So obviously, I'm going to use 900 million. Okay, now the plant has an expected useful life of 20 years. So this is the life of the assets, all right, and it's depreciated on a straight-line basis with no residual value required. State the type of the grant that Prospect Nigeria has obtained and given reasons. We already said it. This is related to asset because a grant from the government is related to construction of a project. Okay, what's it called? Plant. Okay, so that's it. Then 2, show how the assets and the grants will be reflected in the statement of financial position and then statement of profit or loss for years ended 31st December 2013, 2014, 2015, under both methods. Did you see that? There's no way, anytime the examiner decides test as 20, it's going to test both methods. So you can't say, I know method 1, I don't know method 2, or I know method 2, I don't know 1. So you have to blend it together. Okay, so let us try to solve this question. I think I would like to work it out for you, if you don't mind, so that you can see. It's just to apply the principle. It's very straightforward. So let me see if I can pick up my board, and let's try to solve that question. Okay, where is the board? I'm trying to look for it. Okay, I think the board is here, so I want to believe you can see the white marker board. Sorry. Okay. So dealing with IAS20, if you can remember. Of course, this is Prospect Nigeria PLC. Okay, so the examiner said we should show how the grants will be recorded. So we're going to be dealing with method 1. Okay, so we have method 1. Okay, so in our method 1, we're going to take a look at what's it called? Statement of profit or loss account. Okay. Okay, let me just manage it like that. So these are method 1. So what is method 1 saying? So remember, we have, I think we have 3 years, 2015, 2014, and of course 2013. Okay. Then we have our Naira sign. I'm not sure yet. I think it should be in million, if I'm correct, or probably in 1,000. I'm not very sure, but let me just put million first. Okay, so we have these 3 years. And method 1 says, set up a deferred income and spread over the life of the asset. The solution is in your notes. Okay, but let me work it out so that you can appreciate how the solution is done. Then let me try to pick the question up from my study test here. I think here I have it on page 117. Sorry, I'm trying to look for it. Okay, I think I'm there. All right, so let me look for the question. Okay, here we go. Okay, so we needed 2 things here: the grant that was given and of course, the cost of the assets. So the grant is 100 million, and the cost of the assets is actually 900 million. So in my income statement, I'm going to put up my expenses, okay? All right, so you remember, you can start with income, whatever way is convenient for you. So the first thing is to take a look at my depreciation. So you agree that depreciation will go under expenses. So normally, how do I compute my depreciation? I will say cost minus residual value over number of years. I've done that under income. Under IFRS 5, you don't forget. So that's it. You need to understand that. So that's the basics, or that's the foundation. So what is the cost of this particular asset? It says it is 900 million. You say with new residual value, so I don't have residual value, then I can depreciate. I can divide it by number of years, which is 20 years. Okay, so we have 20 years here. So then I pick my calculator. Do I have my did I bring my calculator to the class? Oh my. Okay, yeah, I brought my calculator to the class. Oh, okay, it's working today. Thank God. Some other days it may decide not to work. Okay, so I will say 900 divided by 20. What's that giving me? It's giving me 45. Okay, that's 45 million. If I have used in thousand, I would have said 45,000. Okay, so since we have used a million, so I'll just say that means in 2013, I will charge depreciation of 45. I will charge depreciation of 45 every year. I'll be depreciating the asset for the next 20 years. How much am I going to charge? I charge 45. Then, after I've done that, I'll now come to my income. Because this is an extra, you can decide to put it in jackets, okay? Because obviously it's an expenses, and you can even close it because it is an extract, okay? Then I come to my income. Remember, we are just dealing with the accounting principle under IAS20, set up a deferred income and spread over the life of the asset. That's what we are doing. So what do we do here? So what does that mean? I think I explained it last time. It simply means that if I have a grant of 100 million, all right, to buy an asset that worth 900 million, it doesn't make economic sense to charge the whole 100 million into the income statement in 1 year as an income, okay? Because that money or that grant is related to a particular asset that we use 20 years, okay? So ideally, I should also spread that 100 million over 20 years. That's what IAS20 is saying, okay? I should also spread it over 20 years. That's why I now say, set up a deferred income. You delay it, okay? You accrue it. And you now be releasing it into income statement every year. So that's what it's saying. So we now come to income. So once you understand that principle, apply it on any question, then you'll be good to go. Then I will now say government grant, okay? Government grant. So instead of me to have recognized the whole 100 million in 2013, I will say no, that's not what the standard is saying. So I will also come here and say, how much is the grant? Question says it is 100 million. What is the number of years? It is also 20 years. Okay, so how much should that be? 100 divided by 20 should give me 5. So that means in year 1, I will charge 5. That's 5 million. Okay, in year 2, I also release. No, it's not charged actually. I will release because I will recognize that income. Okay, so in year 2, I will also have 5. Then in year 3, I will have 5. You won't put it in jacket because it is an income. So it has to be naked. Okay, so that's it. So that's what you do in your income statement. Then we are not done yet. I will now go to what's it called? Statement of financial position. Remember, we are still under method 1. Statement of what's it called? Sorry about that. My host please me to disable what's it called? People able to move themselves and all that. Sorry. Okay, let me try to do that. All right. Okay, I think I've done that. Okay, sorry about that. Now, so we are dealing with what's it called? Statement of financial. Sorry. Okay. Statement of financial position. Okay. Statement of financial position. Okay. So what do we do here? We come up with our years 2013, 2014, and of course 2015. Okay. You see, you don't need to bother yourself. All you need to understand is the principle. Once you understand the principle, the next challenge will be how do you apply it to a question? That's why we are doing this, so that you can see how it should be done. So you remember in my SFP, I have something like assets, non-current assets. So you can just say assets or non-current assets. So what is the assets that we have here? So I can do it in two ways. So depending on the way I wanted to do it. Well, let me do it this way. Let me do it this way. Let's look at the cost of the assets. Okay, what is the cost of the assets? So remember, the cost of the assets is actually what's it called? 900 million, 900 million, and 900 million. So if I use a constant figure for the cost of the asset throughout the year, then I need to compute accumulated depreciation. Okay, so we now say accumulated depreciation because I'm already using a constant figure. In year one, remember, we are charging 45. That is my depreciation. So I will say 45. Did you see that? Then if I say 45, what will this one give me? It's going to give me something around what's it called? Is that 855? Okay. Then in year two, because I maintain constant figure. If I'm not maintaining constant figure, this 855 will be the current amount in year two. Is that okay? So you can do it that way. So maybe I'll also do it for you, but let me finish this. But when I come here, I will now accumulate it. That means in year two, it would have been 90, 45 plus 45. So it's going to give me, is that 90, Abi? Okay, yeah, 45 plus 45 should be 90. Then I remove that 90 from 900. So if you do that, it should give you something around 810. Okay, so that's that. Then when I come here, it would have been 3 years. So that means 45 in 3 places. That should give me, is that 135? If I'm not correct, please let me know. Okay, so 135. Sorry, I'm trying to deal with one issue here. One technical, sorry. Okay. Sorry about that. Okay, so let's move on. So if I say 900 minus 135, that should give me, is that 765? Okay, so you can decide to do it this way. Of course, this will be the carrying amount. Okay, if I don't want to do it that way, there's another way I can do this. Okay, after saying 900 here, okay, can you see? This is 900, then I charge 45, then I have 855. So I can actually bring the 855 here, okay? If I bring that's in year two. If I bring that 855 there and I remove 45, okay? I remove 45, obviously it should give me 810. You can confirm that, all right? Then this 810 will be the kind amount in year three. Did you see that? It will be the kind amount in year three. Then I charge 45 again. If I do that, it should give me 765. So that's it. So it depends on the way you want to go about it. Okay. So I just needed to explain that to you so that you can understand. It's the same principle of depreciation. Then I will now go to my equity section because we don't have share capital and all of that. So we'll start straight with non-current liability. Okay, non-current liabilities, Then we also, under the non-current liabilities, we now have something like government grants. Okay, we have government grants. Then we have current liabilities. Current liabilities. Current liabilities. Okay. Then we have government grants. Sorry. Okay. So we have okay, so be with me here. Be with me here. So this is where you need to understand. So you have to be with me here. How much is the grant? Total grant is 100 million. Okay. Remember, this is the area we are setting up a deferred income. So technically, it will be recognized as a liability. If you read our question, they were saying if they didn't meet certain expenditure, then it will trigger repayment. So that is why prudency will require that you don't recognize all the 100 million. You will be seeing it as a liability. And as you are fulfilling those obligations, or year in, year out, you will not be recognizing it in the income statement. So that's the idea. So how do we now set up that deferred income? It is around current and non-current. Remember, current liabilities will be due in the next 1 year, and non-current liability will be due in more than 1 year. So that's the idea. So what do we do here? Then you ask yourself, when you come here, how much is the grant? It says 100 million. Okay, so please be with me here. How much is the grant? It says 100 million. How much have I charged into the income statement? In 2013, I have charged 5. Did you see that? I have charged 5. I recognized 5 in 2013. How much is remaining? Is remaining 95. Okay, if it is remaining 95, how much will I release next year? I will release another 5. Okay, so that means I have 90 left. So that 90 will be non-current. That's it. So 90 will be non-current. Let me say it again. You be with me. Listen to me one more time. So that's why you're in class. And that's why I have to solve it for you. I don't just want to be explaining in that material. How much is the grant? 100 million. How much have I released in the income statement in 2013 year end? I have released 5. How much will I release next year? 5, okay? Because you have already done it in the income statement. That means I have 90 left. More than 1 year, okay? So if I'm releasing 5 every year, in 2014, it will be 85, and in 2015, it will be 80. That's it. That's what you are doing. And for my current liability, it will be 5, it will be 5, it will be 5, because every year I'll be releasing 5. And that is the end of method 1. That is what it's saying. It looks so simple. But if it comes out to the exam and you don't have the slightest idea, you can't do it, all right? So these are questions that when you see them flashing you in the exam, you pick up those marks as easy as possible. So that is what it's saying. Do you have any question for me so that I can clean the board and do method 2? Method 2 is very straightforward. It's very straightforward. Okay, it's only method 1 that has a little technicality around the deferred income. But if you really listen well, you see that it's not really something you cannot, that you cannot undo. Okay. Any question for me? Do you understand? Okay. Do you understand? Sorry, that 90 network didn't make me to hear. Okay. Yeah, let me explain it again. You know, we said we have 100. The grant is 100. Okay. The grant is 100. Okay. So let me demonstrate that again. If the grant is 100 in 2013, at the end of 2013, I have recognized 5. Okay, did you see that? I have recognized 5 already. I have 95 left. Then I will recognize 5 by the end of next year, which is 2014. So non-current will now be 90. So that's how we got this 90. Did you see that? Then every year I'm releasing 5. Then you have 85 and you have 80. Then for the current liability, you're releasing 5, 5, 5 every year. Is that okay? So that's it. That's it. So I hope that is understandable. Then I can go to method 2. Any other question? Any other question for me? There's no question. Have you done all your screenshots before I clean the board? So I need to clean the board so I can do method 2. There's no question. So let's move away because we need to at least finish one more standard, IAS23, borrowing costs. then maybe you start a new standard. If you can finish the next class. Okay. Okay. Okay, so let me go to method 2, since I don't have any other question. So let's take a look at method 2. What is method 2 saying? Okay, how do we apply that? What is method 2 saying? If I want to be quickly explaining everything, we won't cover. You are going to watch the video. You are already spending 30 minutes, and I have a target tonight. Okay, so I would rather prefer, if you don't understand, it's different from me going back, probably because you miss some parts and all of that. Okay, all right, because you're going to have access to the recorded video, so you can always watch it, because we need to move faster. Okay, but if you don't understand, I'll be glad to re-explain rather than going back because we miss a class. So please bear with me. Okay, so I have a target. It's for your good. It is for your good. Okay, so I wanted to cover as many standards as possible. And after this class, I have 2 more classes for you. And I must treat ratios. And I must treat IFRS 15, revenue from contract with customers. So and I can also touch on financial instruments. Okay, so that's it. So let's take a look at method 2. So we are still on IAS20, and this is a Prospect Nigeria. Prospect Nigeria PLC. Prospect Nigeria PLC. So let's take a look at method 2. Method 2. What is method 2 saying? Method 2 says deduct the grant from the cost of the asset and spread over the life of the asset. It's as simple as that. Unlike method 1, set up a deferred income and spread over the life of the asset. But here, you are going to deduct the cost of the grant. You are going to deduct the grant from the cost of the asset. Then the balance, you now spread it over the life of the asset. That is exactly what we are doing here. All right. So let's take a look at method 2. The same way, we will say statement of profit or loss account, statement of P or L account. All right. Okay. In your exam, make sure you write it in full. Then we have 2013, we have 2014, and of course 2015. Okay. So what do we do here? You put your Naira sign. Don't forget to always do that. You put your Naira sign. Then you say expenses. And like I said earlier, you can, if you are doing method 1, you can start with your income. But here, we won't do income. Do you know why? We would have deducted it from the cost of the asset. So we now compute our depreciation. So we compute our depreciation. How do we do that? Normally, my depreciation will be cost minus residual value over number of years. So what is the cost of the asset here? What is the cost of the asset? The cost of the asset is actually 900 million. You can remember. So if it is 900 million, okay, I will not divide the 900 by 20 because this is method 2. I would have deducted the 100 million. Okay, you deduct the 100 million. So when I deduct, what do I have left? I have 800 million left. All right, I have 800 million. So the 800 million, I will now divide by 20 years for me to get what's it called? My depreciation. So when I do that, it should give me 40. I'm correct. If my head is not, my brain is not failing me, it should be 40. Okay, it should be 40. Now, if you remember method 1, we had 45. If you remember, we had 45 under depreciation in method 1 because it said 900 divided by 20. But we recognize income of 5. If you net it off, it gives you this 40. Did you see? It's the same impact on the financial statement. The only difference is method 1 is showing that government grant came in, but this method 2 is not showing it because we have already deducted it from the source. That's the only difference. At the advanced level, maybe in corporate reporting, or you decide to do FCA, they can now decide to ask you which of these methods is is most relevant, or do you prefer? Okay, it's an argument. Okay, some people will say method 1 is most relevant and most preferable. Why? Because it's showing the source of the income. Another school of thought says no, it is method 2, because government grant is not something that is regular. It's not something that comes in every year, every now and then. So why are you showing it? So it's better you deduct it. Meanwhile, IAS20 allow both methods. In fact, this method 2 conflicts with the conceptual framework, all right? Because when you look at general purpose of financial statement, you don't offset. You're supposed to show your income, show your expenses, and all of that. But anytime there's a conflict between the conceptual framework and a standard, the standard will prevail. Standard will prevail over the conceptual framework. So that's the idea, okay? They did not send me all those ones. I just needed to explain to you, okay? So that's the argument. But because you are just, especially if you are just being exposed to financial reporting, you may not really understand all of those. But you need to start preparing your mind so that when you get to advanced stage, so you now, get the understanding better. But at this level, nobody bothers you around that. So you keep wondering, why am I still doing these standards, all these standards at the professional level? Because they take it more higher so that you can have deeper understanding. So we are still on method 2. So let's now go to statement of statement of financial position. Statement of financial. I'm not sure whether I'm getting those spellings correctly. So please pardon me in case I'm not getting it correctly. I'm not sure. Okay. We have 2013. We have 2014. And of course, 2015. Then you do your Naira sign. I do my Naira sign. So what do we do here? We have our asset. Okay. So how do we compute it here? The same way. Okay. The same way. So we will say, what's it called? We say, what will be the cost of the asset? Abi? So our cost, Abi, 900 million, if you can remember, 900 million minus, because we are deducting it from the source, minus 100 million. So if you do that, you're going to have, 800. So let me maintain constant figure, just like we did earlier, 800, and of course, 800. So I'll now come here and charge accumulated depreciation. So most likely I'll charge 40 in year 1. I will charge, 80 in year 2, and I will charge 120 in year 3. Okay, why? Because we maintain constant cost at the at the beginning of each year. Okay, so we can do this. We can do this. So if I remove 40 from that, that should give me 760. If I'm not mistaken. Sorry, let me do with this. Sorry, please. Okay. Okay, so let's continue. So if I remove 80 from this, that should give me, is that 720? I hope I'm correct. Then if I remove, how much is that? 120 from that, I should have, is that 680? Okay, I should have 680. I should have 680. Okay, thank you, Jimmy, for doing that for me. Thank you so much. Okay, so this will be my carrying amount. If you are not comfortable with that, you can do this. Okay, after 2013, and you got 760, you can pick the 760 and put it here. But that means you are going to charge 40. If you charge 40, you should have 720. Then bring on 720, becomes the current amount in the next year. Then you charge another 40. If you do that, you should have 680. So that's it. So whichever way is convenient for you. This is method 2. You can imagine that question is 20 marker question. Okay, you can see cheap. It's so cheap. You have your 20 marks. You have done well in question 1. Let's say question 1 is around 30 marks, and you're able to get maybe 15 out of 30. That is 35 already. Then you're able to do your ratios, or maybe cash flows and the likes. You already pass FR. It's as simple as that. Okay. And most likely, you may even some other questions there are 15 or 10 marks, all this computation, the theory part of the questions, you see, so you are passed. So that's it. So if IAS20 should come out, then it should not be a big problem for you. So you should be able to undo that. And that is the end of IAS20. I'm going to go to, what's it called? What's it called now? IAS23. Okay, borrowing costs. Okay, borrowing costs. I'm going to go to IAS23, borrowing costs. Any question for me on this? There is no question. I wanted to finish this by 7:30, but this is 7:38, so we spent, additional 8 minutes, but that's still fine. So let's see whether I can finish off borrowing costs by 8:15, so that I can start 16, or I can explain those three standards together, IAS16, IAS40, and IAS38, so that next time we solve questions around it. But let me see how my spirit is leading me to do all of that. Okay, so there's no question for me, I suppose. So let's go to IAS23, borrowing costs. Let me see if I can pick up the slides. Okay. All right. Sorry. Okay, IAS23 borrowing cost. Okay, now permit me to go to the boardroom again so that I can really explain. Then I come back here and bring. Okay, method 2 is more straightforward. Of course, yeah, it's very straightforward. Yeah, but even method 1 is not also bad. Okay, it's just for you to understand, the technique and apply it to that question. Okay, this is my thing. This is my own philosophy. Let me tell you, if somebody can know it, you can also know it. Okay? So don't say something is difficult, you can't know. Somebody knows it, then you can know it. If I have 5 hours, or let me say 8 hours with you, I'm going to run the whole standards in financial reporting on this class at a stretch without looking at any book. Okay? So if I can do that, then you can also do that. So that's the philosophy. So that's the belief. So just have that mindset that if someone can know it, if a brain can know it, then my brain can also, accommodate it. Okay. So, but let's see how far we can go tonight. IAS20, borrowing costs. Okay. Borrowing costs. Okay. So let me, I don't like looking at material when I lecture. So, let me start to display all of these things on the board so that I can really explain, but I'll be as, quick as possible, right? So we are dealing with IAS23, borrowing. You can see the 2 inside there, right? Borrowing costs. All right. Now, what is this one saying? Let's find out. What is this one saying? If I go to the bank to borrow money, they won't give you that money for free. Is that okay? They won't give me for free. So there's an interest that will be charged on that borrowing or on that loan that I'm going to borrow. And that's what we call finance cost, or they call it interest. Although finance cost, the concept is quite wide. There are so many other things that form part of the finance cost. Okay. So most times I don't really like using finance cost. So I prefer to say interest on loan. But if you say finance cost, you're also fine, right? Then, but here we are dealing with borrowing cost, all right, which is also interest on loan. So if I go there to borrow money to finance my operation or to build an asset, all right, then I'll be charged interest on that loan. So that means when I'm repaying, I'll be repaying both the principal and the interest, right? Now, before IAS23, that interest is usually expensed. So that is what you see under finance cost, right? So if you pick up a financial statement and you see finance cost, go and look at the notes to the account. Most likely you'll see interest on borrowing as part of the finance cost, right? So it is usually expensed, right? Now, IAS23 now came on board. IAS23 is now saying, instead of expensing all borrowing costs, remember, borrowing costs are interest and other costs that an entity incur in connection with borrowing of funds. So instead of expensing, when I say expense, You take it to profit or loss account. It's a charge, part of my expenses, and it will reduce my profit for that year, all right? So rather than expensing, why can't you capitalize? What's the meaning of capitalization? You take it as an asset. If you notice my words, I said take it as an asset. But you don't tell the examiner, take it as an asset. You recognize it as an asset because I wanted you to understand. So that's why I use off languages earlier. Then later on, I come to technical language. So for financial reporting, you need to learn those technical language. You can't use English, plain English, to answer the examiner, all right? Expense. That means you take it as an expenses in income statement. Then you recognize or capitalize in the statement of financial position. Do you see that? So the issue now is if an asset, if I borrow money to construct an asset that we use that has an economic life of 20 years, why am I charging the whole interest in a particular year? Okay, why can't I also capitalize? So that means I will take it as part of the cost of the asset. Let me quickly say this. I will recognize it as part of the cost of the asset in my statement of financial position. I will now be depreciating over the years of the asset. Did you see that? So rather than recognizing the whole interest, the same asset will still suffer depreciation in that particular year. Then it affects the profit. So why can't I capitalize, all right, and be releasing it systematically on the account? So that's the idea around IAS23. But before you can do that, you need to check that the money you have borrowed is related to, sorry, I'm looking for my marker out, that's running away. It's related to a qualifying asset. Okay? It has to relate to a qualifying asset. What's the meaning of qualifying assets? They are those assets that take substantial amount of time to get ready for intended use or sale. Can I say that again? A qualifying asset is an asset that takes substantial amount of time to get ready for its intended use or sale. For example, you want to construct 3rd Milan Bridge in Lagos or 4th Milan Bridge. You want to construct Kanji Dam, supermarket, head office, national stadium, right? You can't do that in 2 months. It's going to take a while. But remember, this is IFRS. Substantial amount of time is judgmental. So you apply judgment. So if you go to the bank to borrow money to construct a qualifying asset, those assets that will take substantial amount of time to get ready for the intended use of sale, then you can decide to capitalize the interest on those borrowing. That is what IAS23 is saying. Did you get the point? In the exam, the examiner can ask you, differentiate between depreciation and impairment. You have attended my class and you can't do that. You're on your own. He can also ask you, what is a qualifying asset? Then you tell him immediately, there are those assets that take substantial amount of time to get ready for the intended use or sale, right? So if I now borrow money that relates to a qualifying asset, then I can decide to capitalize. But there's a caution approach to that. IAS23 is saying not all borrowing costs should be capitalized, all right? So it regulates the amount of borrowing costs to be capitalized. And that will now take us to period of capitalization, right? So after you have learned what borrowing cost is, you can explain a qualifying asset. Then I'll be glad to take you through period of capitalization. Okay, period of capitalization. There are 3 of them. 1, when do you commence capitalization? So that's the first thing we're going to look into. Sorry. So the first thing is commencement. Commencement of capitalization. I'm not going to write all those conditions, so I'll just be saying it, save time. So we are going to, it's everything I'm saying is in your notes. Is that okay? All right. Now, commencement of capitalization. What does that mean? When will I start to capitalize interest on a qualifying asset or interest on borrowing relating to a qualifying asset? There are 3 conditions that must be met before I can commence capitalization. What's meaning? Before I can start capitalization, all right? 3, that is how to learn. 3, so when you are studying, you already know there are 3. Number 1, expenditure for the asset is being incurred, okay? Expenditure for the asset is being incurred. Maybe I should try to write it so that, because I need to ask you a question on that. So let me try to write it. I think I'll try to be moderate about that. Okay, so the first condition is expenditure for the asset. Expenditure for the asset is being incurred. Expenditure for the asset is being incurred. Okay, then number 2, borrowing costs. Borrowing costs. Borrowing costs are being incurred. Are being incurred. Then number 3, all activities necessary, okay, to get the asset ready for its intended use of sale have started. So let me just shorten it that way to save time, right? All activities necessary to get the asset ready for its intended use of sale have started, or they are in progress. These 3 conditions must be met before I can capitalize or I can commence capitalization of borrowing costs. If you meet 2 conditions, you cannot capitalize. If you meet 1 out of 3, you cannot capitalize. All the 3 conditions must be met before you can capitalize. So right from this class, you need to quickly learn it. Okay, you need to quickly learn it. When can I commence capitalization of borrowing costs? When expenditure for the asset is being incurred, borrowing costs are being incurred, and all activities necessary to get the asset ready for intended use of sale have started. So my students, grab your key parts and answer this question. Grab your key parts and answer this question. Sorry, I'm coming, please. Okay, so grab your key parts and answer this question. Expenditure for the assets was incurred on 1st of March, okay? 1st of March 2021. Borrowing cost was incurred on, let's say, 1st April 2021, okay? Then all activities necessary to get the asset ready for intended use of sale started, let's say, 1st January 2021. So grab your key parts. When will I commence capitalization of borrowing costs? I want to hear from you. When am I going to start? Expenditure started 1st March 2021. Borrowing cost was incurred 1st April 2021. Then all activities necessary, for example, planning permission, whatever, was already gotten in January. Okay, all the 3 conditions has been met. But when will I commence capitalization? Is it 1st January? Is it 1st April? Or is it 1st March? So I need to hear from you. I'm already seeing answers. I saw 1st March. I saw 1st April. Okay. Okay. I think I have more of April than March. Everybody was saying April. Okay. I have one person that said March. Okay. All right. Okay. Somebody said April. Okay. Thank you for your responses. Well, yeah, be with me here. If you have said April, be with me. And if you have said March, also be with me. Okay. So let me do the analysis for you. What does this mean? Okay. What is the meaning of expenditure for the asset is being incurred? What does that mean? I'm already buying blocks or cement I have employed laborers to come and start working. So work has started. And when did it start? It started 1st March. Have I borrowed money 1st March? The answer is no. I have not borrowed money. I was using my money. So at that time, I have not incurred borrowing costs. Did you see that? Commencement will not, money, capitalization of borrowing costs will not commence because I've not even borrowed money. Okay, that is what is meant by expenditure for the asset is being incurred. So it actually started in March, but I was using my money to do clearing, to buy blocks, to buy cement, to employ laborers. So they are already working there, and I was using my money, okay? But my money was not sufficient, or it's not going to be sufficient. Then I decide to go and borrow money in April, okay? The banker or whoever is lending me the money, you start charging me interest in April. You cannot charge me in March because I did not borrow money. So that is the logic, okay? You need to understand. You see, anytime I do this, or even from right from the beginning, when I lecture financial reporting, I keep saying date is very important. What will make you to fail FR exam is because you don't take cognizance to the dates. Look at the requirements. The examiner will say, discuss the accounting treatment as at a particular date. If you don't take it into consideration, you are shooting yourself in the leg. So 1st April, it was when I went to borrow money. So it started charging me interest from that day. Because as of March, I have not borrowed money. And I met this condition, then that means from 1st April, I'll decide to capitalize. So that means if anything did not happen, I will capitalize April till December, depending on the scenario. That's about, is that 9 months? Okay, that should be 9 months, all right? That's it. So it's not going to charge me interest for the full year because I borrow money 1st April. So that's it. I have another question for you before I move away from here. Okay, one last question. So let me upturn this question. So let's say expenditure for the assets started 1st April. Started 1st April 2021. That means I started buying cement. I started employing laborer 1st April 2021. Meanwhile, I borrowed money 1st March 2021. Did you see that? I borrowed money earlier, 1st March 2021. Then all activities, clearing permission and all of that, I already gotten that one 1st January 2021. This is a question for you. When will I start to capitalize borrowing costs? Okay, grab your key parts and go there. Please talk. Okay, let me be sure. Let me be sure you know this. Okay, when will I start to capitalize borrowing costs? Okay, I saw 1st April. I saw April. Everybody is saying April. Okay, somebody said 1st of March. Okay. So somebody said first, the same scenario we had in the first question. That's the same scenario we're having. So I like your responses. If you are not talking, I wouldn't know. Even you yourself, you would be thinking you are right. Meanwhile, you may be wrong. Okay. Somebody also said 1st April. Okay, thank you for your responses. But yeah, be with me here again. Sorry. Oh, sorry, I don't have my water here. Okay, I saw 1st April again. Okay, no problem. But yeah, listen to me. What does this mean? 1st April 2021, expenditure started, all right? Meanwhile, in March, okay, I think I have one more response. Let me check. Okay, that one, the person is also saying Messi. Messi is saying April as well. Oh, yeah, let's see whether, even me, I don't know the answer, okay? But let us analyze it. That's what I normally do. If you ask me a question, I don't know the answer. I go back to the principle, which is the standard. Then from the standard or from the principle, we will see the answer ourselves. It's as simple as that. So what is this principle saying? So let's find out. Borrowing cost was incurred. What does that mean? I went to the bank in March to borrow money. Did you see that? I went to the bank in March to borrow money. So when I borrow money in March, can you see? I borrow money in March. What does that mean? I'm already incurring interest. Okay? I'm already incurring interest. You know, I told you earlier that all the 3 conditions must be met. So when I incur interest in March, am I going to start a capitalization of borrowing costs? The answer is no. No way. I cannot commence capitalization in March, even though I borrowed money in March. Do you know why? Expenditure for the asset has not started. Expenditure started 1st April. that is when I begin to capitalize. What does that mean? The interest in March, that interest on borrowing will be expensed. You know, I told you earlier that before IAS23 came on board, interest on borrowing are usually expensed. All right? Then the standard now came on board and say part of that interest can actually be capitalized, provided they are related to qualifying assets and certain conditions are met. So this is the issue now. So because expenditure have not started, even though I have borrowed, I'm incurring borrowing costs already, it will be expensed. All right? It will be expensed until I started expenditure. Did you see? So I hope it is clear. So sometimes you think you know it until you start applying it to scenarios before you can be sure that you know that. So that's that. So let's now go to number 2. Let me quickly explain number 2 so that we can solve questions. I just have maybe one major question that we solve, but let me quickly do that. Number 2 is suspension of borrowing costs. Suspension, okay, of capitalization. Let me call it capitalization. It's also borrowing costs actually. That's capitalization of borrowing costs. Okay, suspension of capitalization. When do I suspend? Suspension is not cessation. Okay, in most textbooks, you see commencement and cessation. Okay, that is not correct. There is commencement, there is suspension, and there is cessation. So that's what I'm teaching you. What is the meaning of suspension? You temporarily stop, capitalizing borrowing costs. That's it. All right. So what's the standard saying? The standard is saying you suspend borrowing costs if there is disruption to active development program. Okay, borrowing costs shall be suspended. Okay, so let me just do this. Borrowing costs shall be suspended if there is disruption. If there is disruption. If there is disruption, okay, to active development program. That means we will not capitalize for that period. Okay, to active development program. What does that mean? For example, e.g., okay, e.g., shortage of labor, shortage of what? Of labor or material. Okay, shortage of labor or material. That's a classical example of active disruption to a development program. So they have started in April or they have started in March. Then around June, they couldn't get supplies again. So they are not working again. For that period, you will suspend capitalization of borrowing costs. So what do? You expense. Okay, you expense. So once there is active disruption, once there is disruption to active development program, borrowing costs shall not be capitalized. All right. However, be with me here. I won't be able to write this. However, if disruption to the active development program is necessary for the asset to be ready for its intended use of sale, borrowing costs shall not be suspended. Let me say that again, and I'll give you an example. Borrowing costs shall be suspended if there is disruption to active development program. For example, no labor, industrial strike, COVID-19, and all of that, lockdown, blah, blah, blah. That period, you will not capitalize borrowing costs. But if that disruption is necessary, that means waiting, or that disruption is necessary to get the asset ready for its intended use of sale, then borrowing costs shall not be suspended. For example, let me give you a classical example. Let's say you are constructing a building. Then when you get to a particular level, then you now cast the building. You are doing decking, cast the building, and you are waiting for that casting to solidify. When you cast a building, they will say wait for 21 days. to be waiting it every day, or you wait for 30 days or 1 month, all right? That waiting time is necessary to get the asset ready, all right? In that case, you will not suspend borrowing costs. Do you see the issue now? So if that waiting time is necessary, borrowing costs shall not be suspended. So if the examiner, want to play around that, it's going to tell you, okay? So it gives you that kind of scenario. But once that disruption is not necessary, then you have to suspend borrowing costs. So I'm going to show you in questions on how to do all of that. Then the last one is cessation of borrowing costs. When do you stop borrowing costs? Finally, that is cessation. Sorry, that should be C. That is cessation of capitalization. Two things will happen that will make you to cease, okay? Two things. I won't be able to write that, so let me say it again. Two things will happen. Substantially, the project has been completed. Substantially, you have completed the project. Then number two, the project is abandoned, right? You're not doing it again, just abandon it, even though it's not completed. So if you have abandoned it, then you stop capitalizing borrowing costs. Any question for me? So I'll go back to the slide, show you some questions around here. Then I'll come back here and explain two more things: specific borrowing and general borrowing. What do you do around there? Then I'll go and solve one bigger question. Then we'll say bye-bye to IAS23, borrowing costs. Any question for me? There is no question for me, okay? There is no question. It means you're enjoying, you're enjoying is it the vibe? I'm not sure. But let me know if you're enjoying this, okay? Let me know. You can just give me some feedbacks. I can't really see you. I wish it's a physical class. I would have seen their reaction. I don't know whether they understand or they don't, so I can probably explain again. But here I can't see you. So whether you're laughing at me or you're laughing for me, I don't know. All right? Because I can't really see you. But you can let me know if you are enjoying this. So let me go back to the slide. Let me go back to the slide and try to demonstrate what I've explained in some questions, okay? Remember, it is intensive. I'm just going straight to the point, what the examiner will require you to do in the exam. So we have an exercise here for us. I'm not going to solve this question on the marker board, so I'll just explain from here. Is that okay? Then, but I'm going to solve one big question for you on the marker board. I think I should be able to do that. Okay. Okay, thank you so much for thank you so much for your feedbacks. All right. So that's just to that's just to be sure, all right, and to encourage me to say more when I know you're actually getting the point. Exam is now 10 and 12. God help us. Obviously, God will help us. But if you see, we have, I think the online class is quite very strategic, because naturally it's supposed to finish by May 1, okay? So you still have ample time to do a lot of revision, okay? Even if it is 10. So just go and double up and start reading, all right? Okay. Love in the here. Wow, that's nice. Okay. Now we have a question before us. Okay. Now look at this question. Let me go to the requirements. Sometimes when you see question, the first thing is you can go to the requirement. It says, discuss the accounting treatment. I like this kind of question. I normally tell my students that I like question like this. In fact, at this level, you may not see more of this. All right. The examiner will say, according to this standard, according to that standard. But at the professional level, it won't say that. This is what it's going to say. Discuss the accounting treatment in the financial statement for the year ended. Then you are wondering, which standard is the examiner testing? Because it says, discuss the accounting treatment. So that's why I love this kind of question, so that I can show you how to determine the particular standard that the examiner is testing. So let's find out. So from the requirement, I don't know the standard. Okay. So he said, on 1st January 2021, IRIS obtained planning permission to build a new office building. That statement is not telling me this is IAS23. It could be, because the office building, it could be IAS16, it could be IAS40, but it cannot be IAS40. Do you know why? It said new office building. It can be IAS40 if they decide to rent it out and earn rental income. I'm going to explain all of that to you when we get there. But because the new office building, if they are going to use it, IAS16 can apply, because that means they are using it in production of goods or services or for administrative purpose. So that statement is not really telling me. But in my head again, I know that building, it can be a qualifying asset. Do you know why? Office building. Do you know why? Because it will take substantial amount of time to get ready for its intended use or sale. So that is playing in my head, but I don't know yet. It now says construction commenced on 1st March 20X1. Oh, okay. So they want to construct to help fund this building. A loan of 5 million was taken out. Did you see that? No, I don't need a soothsayer to tell me that this is a borrowing cost. If they have not gone to borrow money, it can never be borrowing cost. So you see, once you know the principle, you will fly, okay? You just be smiling in that exam. He said to help fund the cost of the building, he went out to take a loan. Then, and I've told you that you can only, a borrowing cost or IAS23 will only apply if you borrow money. Not only borrowing money alone, you borrow money to construct a qualifying asset, or to construct, to acquire, or to produce a qualifying asset. So you borrowed money on 1st April. The interest rate on the loan was 10%. Construction of the building ceased during the month of July. What does that mean? Then that should be, I'm thinking, is this cessation or suspension? Although he used the word ceased. Why? He said, due to unexpected shortage of labor and material. Did you see that? That is suspension. By December 20X1, the building was not complete. So if it is not complete, you can't charge depreciation. The cost incurred today were 12 million. Now say, how will you trade this? So this is borrowing cost, IAS23. Then I tell the examiner that before you can capitalize borrowing cost, certain conditions have to be met. The expenditure for the asset is being incurred. When is that? When did they commence expenditure? He said construction commenced 1st March. Did you see that? When you see that, don't look at the solution. I know some of you are peeping at the solution. Don't look at it. Let us solve it together. Okay? Let us solve it together. They say construction commenced on 1st March. Borrowing cost income, he went to the bank to borrow 5 million on 1st April. Did you see that? So when do we capitalize borrowing cost? The answer is 1st April. Even though I have started construction in March, but I went to borrow money in April. So I will start construction in April. I will start what's it called, capitalization in April. Is that okay? So when I count April till what's it called, December, how many months is that? That is 9 months. Is that okay? That is 9 months. Then I check the question. Is there any reason for me to suspend? It says here that construction ceased for some period of time during the month of July. Why? Because of shortage of labor. Then I ask myself, shortage of labor, are you necessary to get the asset ready for its intended use? So the answer is no, it is not necessary. That means I will not capitalize borrowing costs for the month of July. I would have expensed, all right? So out of 9 months, I have 8 months left. Did you see that? I have 8 months left. I will now say 8 divided by 12, because in a year we have 12, multiplied by 5 million. Okay, then multiply by 10%, because it's that 10% that the interest on that loan. Okay, or you can say 5 million multiplied by 10%. You know, the interest is 10% on 5 million, but I will not recognize the whole figure. I need to prorate, and that will be 8 over 12. So whatever answer I get, I will go and add it to the cost of the asset. How much is the cost of the asset? Which is 12 million. Did you see that? I add it and I capitalize. That's it. And that's the end of that question. It's as simple as that. So let me now show you. Can you see? So what you have done, what you have done for the examiner is to state the 3 conditions and put the date. All 3 conditions were met. Then now tell the examiner that 5 million multiplied 10%, can you say multiply 8? How did we get 8? You know, we borrow money in April. So if you count April to December, that is 9 months. Then we're told that in July, can you see it here? There was shortage of supply, a shortage of labor. So in that case, you will not capitalize for July. So when you remove 1 month from 9 months, you have 8 months. So that's how we got this 8. And you have 3. Then go and add it to that 12 million, so that you can have 12 million, 3,000. That's it. That's the end of that question. It's as simple as that. It's as simple as that. Any question for me on this? Okay, at your leisure, take a look at this, okay, and try to, be able to do that. I have two more things to explain to you before I solve a big question. Okay, that's specific borrowing. What is specific borrowing saying? Okay, if you borrow money specifically to acquire a qualifying asset and you decide to reinvest part of the borrowing, the money you borrowed, you now reinvest it, part of it. You know, when you reinvest, you are going to earn what's it called? You are going to earn investment income. Okay, you are going to earn investment income. But the ideal thing is, why will you be making extra money on the money you have borrowed? So IAS23 is now saying borrowing cost that will be capitalized will be the actual borrowing cost less investment income. You may not understand what I'm saying. So let me go to the board, like I told you. Let me go there to demonstrate with figures so that you can understand. So that when we solve questions around that, you understand better. Okay, I have to clean this. Okay. So let me explain. So remember, we are still dealing with IAS23, borrowing cost. So here, I want to talk about specific borrowing, okay, specific borrowing. Now, when I borrow money and I reinvest the borrowing, okay, I reinvest the borrowing. That's what I'm dealing with. Now, the standard is now saying that the borrowing cost that will be capitalized will be the actual borrowing cost. Just like we computed earlier, we will now less investment income. Okay, you're going to less investment income from that borrowing. Okay, so what does that mean? So let's say, let me just give a figure. I'll just assume figure. So let's say I went to the bank, I borrowed, let's say I borrowed 5 million naira at 10%. Okay, I borrowed 5 million naira at 10%. So when I borrow 5 million naira at 10%, you know, I would have paid, is that 500,000? Okay, I would have paid 500,000 as interest, and I would have capitalized 500,000 as what's it called? As part of the cost of the asset, provided I borrow this money 1st January and I don't have reason to suspend. Okay, now, meanwhile, out of this 5 million, I now decide to reinvest 3 million. Okay, I reinvested 3 million and at 3%. Okay, are you getting the point now? I reinvest. Sorry, I'm trying to. Okay, let me do this so that you understand. So this is borrowing. That is loan. Okay, so this is my borrowing, and this is my reinvestment. So I reinvest 3 million. Are you getting it now? Okay. So when I reinvest, sorry, let me quickly deal with this. Okay. So when I reinvest 3 million, I will earn income. That's what they call investment income of how much? 3% of 3 million. What would that one give us? That should be, is that 90? Am I correct? That should be 90, Abby. You can help me to press calculator. Okay, I think somebody is responding. Let me check. Okay, thank you. Yeah. Okay. That means my head is telling me the correct thing. Thank you very much. So that should be 90,000. Okay. So that is investment income. Now, what the standard is now saying is the borrowing cost. Thank you very much for your responses. The borrowing cost that will be capitalized will be the actual borrowing cost. In this case, what is our actual borrowing cost? You know, if I did not reinvest, I would have capitalized this 500,000. Is that okay? But because I reinvested, it's now saying the borrowing cost will now be capitalized, will be the actual borrowing cost. In this case, is 500,000 less investment income. So it's now saying I should remove this 90. So when I remove it, it's going to give me that 410. Okay, so this will now be the borrowing cost to be capitalized. That's what specific borrowing is saying. Is that okay? So if you have a question where it was reinvested. Just come and remove it from the cost of that, or from the actual borrowing cost. Is that okay? So that's what specific borrowing is saying. So that's what specific borrowing is saying. Okay. So let me now explain the last aspect of borrowing cost. Then we can look at the question. I said I wanted to finish at 8:15. This is 8:17. But let's hope we can finish by 8:30. Okay. But I'm not sure. So I think I need to clean the board so that we don't confuse my next explanation. Okay. Now, for general borrowing, we are on IAS23. So let's see general borrowing. General borrowing. What does that mean? What is general borrowing saying? Sorry. What is general borrowing saying? I already have some existing borrowing. Okay. What does that mean? I did not borrow specifically. They are there. Then all of a sudden, I need to construct assets, a qualifying asset. So instead of me to go and borrow specially, I now use part of those existing borrowing for that, what's it called? For the qualifying asset. Then how do I calculate borrowing cost to be capitalized? That's what we call general borrowing. Is that okay? In that case, IAS23 is now saying you are going to apply what we call capitalization rate. Okay? Capitalization rate. So how do you compute that? It's very simple. So just say interest on borrowing. Interest on borrowing or loan. Okay? But let me call it borrowing, because sometimes overdraft can be there. All right? So interest on borrowing over total borrowing or total loan. Okay, depending on what the examiner has given you, then you multiply by 100%. Okay, so let me give you an example. Let's say we have loan 1. We have a 500K at 5%. Okay, then you have loan 2. Loan 2, 300K at let me say at is that 3? Let me use 3%. Okay, I now use part of this borrowing, to construct an asset. What do? I compute capitalization rate. So how do I compute it? I will now say my capitalization rate will now be interest on borrowing. So what would that be? I will now say 5% multiply 500K plus is that 3%, multiply 300K, okay, then divided by total borrowing is going to be 500K plus is that 300K. Did you see it now? Okay, so if I calculate, you can help me to do that. 5% of 500,000. What would that one give you? Is that 250,000? No, sorry, 250. 10% will give me 50K, so that should be 25,000 if I'm correct. Okay, sorry, I'm trying to deal with a lot of issues here. Okay, so this should give me 25K. Okay, somebody is trying to help us out. Thank you very much. Okay, 25K, yeah. Then 3% of 300K. What would that one give us? That should give us 9. So when 9K, Abby, okay, 9,000. Yeah, thank you very much. So when I do that, I will now say 500 plus this. This will give us 800K. So the final figure would have been is that 34? That should be 34K divided by 800K multiplied by 100%. Abby? Okay, thank you very much, everybody. So what do we do here? So 34K divided by 800K multiplied by 100. So we have 4. Okay, so we have 4%. So this is our capitalization rate. Okay, so that is our capitalization rate. So when I now get this capitalization rate, I will now apply it on the cost of the asset. So let me just assume figure. So let's say the cost of the assets is 900,000. So for me to now get borrowing cost, I'll now say 900,000 multiplied by 4%. So what would that one give me? 900 multiplied 0.04. So that will give me 36. Abi, that will give me 36K. Okay. So the total cost, the total cost of the asset will now be 936K. Have you seen it now? 936K. So that's it. That is general borrowing. Any question you've seen around that, then that is what you are going to do. Okay, that is what you are going to do. So that's it. So let us go and solve one ICANN pass question. To demonstrate our understanding on that. So thank you for your responses. So let me go and see that question. Let me go and see that question. Okay. So there's a question, under this. Please take a look at them. Okay. But let me go and solve one bigger question. So this is a general borrowing that I was explaining. Okay. Now we have question 1 ACCA, but let me solve question 2, which is ICANN. Okay. Let me solve question 2. So you can see question 2 there. Let me try to look for where it is on my own study test here. Page 109. Page 109. Okay, so I've seen it here. Okay, let me read from here. Okay, a company might incur interest cost if it has to raise a loan to finance the purchase or the construction of an asset. IAS23 on borrowing costs defines borrowing costs and set out guardians on the circumstances under which such interests are to be capitalized as part of the cost of qualifying assets required. Discuss the conditions that must be met in order to capitalize borrowing costs under IAS23 is setting out when capitalization of borrowing costs should commence, be suspended, or cease. Did you see that? That is 7 marks. This is a 15-marker question. Even if you don't get part D properly, and you are able to get 7 in part A of this question, then you get, let's say, around 3 in part B, because that was 8 marks, right? You have scored 10 over 15. Yeah, pass this question. That's because normally to pass FR or any paper, you must have at least 50% of each question. But if you don't have up to 50%, you must go and get that mark from other questions. So that's it. So even if you don't really know the calculation part, that part, you have got it correctly. And you may want to expect that I should this diet because it's really been a while. It's been tested. Okay? Now, so you can discuss that. Commencement, those 3 conditions, suspension, and cessation. I have explained it earlier because of time. I don't want to go back there. He now gave us this computation. He said, Allen Company Limited has 3 major sources of borrowing. So we're giving 7-year loan, 10-year bank overdraft. The 7-year loan notes have been specifically raised to finance the building of a qualifying asset. During the year, to 31st December 2018, Allen Company Limited spent 114 on the building, and the fair value was 147. Then the company also incurred the following expenditure, so we're giving. They require calculate the amount to be capitalized, So we know already these are IAS23. Even if he didn't say that, part A is already telling us. In respect of the qualifying capital work in progress for the year ended 31st December 2018. So please permit me to go to the boardroom if you don't mind, or I should just explain the computation here. You may not appreciate it. So let me try to solve it for you. I'll be as fast as I can so that you can really, you can really understand that. Okay, so here we go. Yeah. Okay. What's the name of this company? Allen Company Limited. Okay, so I'll come here and say Allen Company Limited. Okay. So the first requirement, the current say amount to be capitalized, and it gives us something. So we'll say we'll have an heading. We must have an heading. So we'll say computation computation of borrowing cost, that's borrowing cost too, okay, to be capitalized, I think the first one is building, Abby, okay, in respect of the building. So that's what you say, okay. Okay, so they gave us in 1,000, as you can see. So we can do this and we can do this. So what is the cost of the asset from the question? They gave us the cost. They incurred 144,000. So you can see that there. Then I will now look at how much am I going to capitalize, you know, as part of the cost of the asset. Sorry. So we now say interest to be capitalized. Interest capitalized. Okay. So how much is our interest from the question? You look at that table. They said average loan in the year, interest expense incurred in the year, then income earned from temporary investment on borrowing. And they now told us that the 7-year loan note has been specifically raised to fund the building. You see, it's only the 7-year note that has been specifically raised to fund the building. And the expense was actually, or the interest, they have computed it for us, is actually 20,000. So we now say, sorry, so we now say interest on loan. That's the interest. They have computed it. They didn't compute it. They give us the percentage. So you apply it on that loan. So you're already giving it to us. So we say 20. So because it's a specific borrowing, so that was an investment income. Can you see? 12,480, and I have to remove it. That was the demonstration I did for you earlier. So I will now say investment income. Investment income. Okay. How much is that? Is that 12,480? Okay. 12,480. So I will press my calculator to get that figure. 20,000 minus 12,480. What is that one giving me? Okay, it's going to give me something around is that what's my calculator getting? It's getting 7,520. Okay, have you seen it? So when I add it to this one, okay, it's going to give me 144 plus 7250. So that should be 151. Okay, 151,520. Can you see that? Can you see that? So this will give me my total carrying amount. Okay, that's my total carrying amount. Okay, so that's it. But they now told us that the fair value, did you see? They said the fair value of the building is 147 at the end of the year, and we are computing as at the end of the year. Okay, we are computing as at the end of the year. Oh, somebody's asking, please, sir, what page is the question are you solving? Okay, if you are on the online class, I sent the material this evening to the group. But if you are joining from the physical class, that should be page 115. Okay, that should be page 115. Okay, so that's our total carrying amount. But it told us that the fair value at the end of the year, is 147. Okay, so this is my fair value at the end of the year. So if my fair value is 147 and my book value is 151, what's the difference? What is the difference? So that should be 151, 520 minus 147,000. So this will give me what's it called? Is that 4520? Did you see that? So if my book value, my current amount is 145, but the economic reality is actually 147. What is that? Impairment loss. Did you see that? Impairment loss. That's it. Can you see? IAS36 is showing face again. All right? IAS36 is showing this. Yeah, thank you very much. Yeah, somebody was answering me. Thank you so much. Okay, so that's it. So that's impairment loss. It's as simple as that. It's as simple as that. So we have finished that first part. So let's go to the second part. What is the second part saying? They also say we should look at qualifying projects. They gave us other expenditure. So we also say computation of borrowing cost to be capitalized in respect of the qualifying projects. Yes, qualifying projects in respect of qualifying projects. Okay, in respect of qualifying projects. So we underline. Okay. So we have our signs. So how much is the cost incurred? So let's find out so that we can compute how much we are going to incur. So cost incurred. So cost incurred, Abby. Okay. Remember, they told us that 7-year loan is specifically borrowed. So that means the 10-year loan and bank overdraft are general borrowing. Is that okay? But we have all these costs. So now look at this cost. Now the first cost was incurred 31st March 2018. How much is that? Is that 16,000 from the question? Okay. Then we have 31st July 2018. That should be 19.2. Okay. I'm just lifting the cost. Then 31st October 2018, we also incurred 12,600. So I need to add this up. I need to add that up. Sorry. Okay, so how do I add up? 16,000 plus 19,200 plus 12,600. So this is giving me 48,800. So this is that for, sorry, 47,800. Okay, so this is my total cost. Okay, so that is my total cost. I will now say interest capitalized. Interest. That's what I'm just doing. Look at the cost, then how much will you capitalized? So interest capitalized. Okay. Now, because it is a general borrowing, I need to compute capitalization rate. Okay, because I will apply that capitalization rate on the cost of the asset. So how do I get my capitalization rate? I will say interest on loan over total loan. So when I look at this question, what is the interest on loan? Look at the table. You will see 14.4 for 10-year loan, then another 14.4 for bank overdraft. They have computed the interest already. I will add it together. Okay, so when I add that together, what will that give me? 14. There's no space for me to do that. Okay, but I've explained capitalization rate for you earlier. So just use that idea to take it. So 14.4 multiplied by 2. So that will give me 28,800. Okay, I will now say 160 plus 80. That is the general loan. That's the 10-year loan and bank overdraft. So that should give me how much should that give me? Okay, that should give me 240. Okay, so I will now say 28,800 divided by 240, divided by 240,000 multiplied by 100%. So it gives me 12%. So 12% is my capitalization rate. Okay, so I will now come here. Interest to be capitalized for 31st March. Okay, oh my mind, I should have used the figures. Okay, sorry, don't worry. 31st March 2018. So what do we do here? So when you look at March to December is 9 months. Okay, Abby, because March to December should be 10 months. Okay, but because it says 31st March, which is also like 1st April, so that is 9 months. So I'll say 9 over 12 multiplied by what is the cost? The cost is 16K. 16K, then multiply by 12%. Do you see that? Multiply by 12%. So I'm going to get a figure. Then I come to the second one, which is 31st July 2018. So July July, I'll count from August, September, October, November, December. That should be 5 months. So it will be 5 over 12, multiply, how much is that? Is that 19.2? Okay, so that is 19.2, 19.2, then multiply by 12%. Then you also have a figure. And the last one, 31/10/2018. Okay, so that would be November, December. So it will be 2 over 12 multiply, how much is that? Is that 12.6? 12.6 multiply 12%. Then you have figure. So let me quickly punch my calculator. 9 divided 12 multiplied by 16 multiplied by 12%. What is that one giving me? Okay. Me 1,440 multiplied by 92 multiplied by 12%. What is that one giving me? It gave me something like 960. Then the last one there, 2 divided 12 multiply 12,006. Then multiply 0.1012. So this one is giving me 2,252. Okay, then I will add up plus 960 plus 1,440. So what's that one giving me? Okay, it's giving me something like 2,652. Okay, 2,652. So I add it up immediately to 4,7,800. So it should give me 50 is that 452? 5452. So this is the total cost of the asset. So if you can do that, you have your 8 marks and total you have 15. So that's it. So that's the end. Okay, thank you very much for helping me to compute. Okay, so that's it. So that's it. I just wanted to appreciate how it is being computed. So that's why I was doing that. And that is the end of IAS23. So take your time. Please take your time to solve that. Okay, and look at IAS23 in totality in case the examiner decides to ask you. Okay, any question for me? Any question for me? How did you get 9.2? It's in the question. That's the cost for that date. Okay, check the question. You see, that's the cost. That's the 31st July 2018. Is that okay? So if you notice, the 9.2 is also here. Let me use my red. So this is it. It's also here. It's in the question. Okay, so it's what I lifted here. I was managing space. That's why I said 9.2. Okay, it should be 9,200. I was just managing space. Any other question? Okay, I want to believe you understand that. Time is gone. Time is gone. But before we go, I think I should introduce IAS16, property plans and equipment. Now next week, I'll take it up with IAS40 and IAS38. All right, I'll take it up with all of that. So let me just introduce it before we go. But any question here? There is no question. If there is no question for me, then we can close. I can close this after you have done your your screenshot. Okay. No question. All right. Thank you for staying tuned. Okay. So I won't bother to go back to the slide. So let me just explain a little bit. Maybe for the next 15 minutes. So we can stop at around 8:55 and give some 5 minutes break for PM. Is it PM? Is it PM that is coming up? I guess so. Okay. There is a standard we call IAS16. That's property plant, and equipment. Okay, property, plant, and equipment. So apart from what PPE is, you need to know what PPE is, all right? You need to know the cost of PPE. You need to know the cost of PPE. After knowing the cost of PPE, you also need to know excluded cost of PPE, excluded cost of property, plant, and equipment. From there, you should know recognition criteria. You know recognition. Okay. Recognition criteria. But before then, I think you should know about subsequent expenditure. Okay. Let me put it there. Subsequent expenditure. Okay. Then after recognition criteria, you should also know measurement criteria. Okay. Measurement criteria. After that, within recognition and measurement, we'll talk about depreciation, so I don't need to pull it out. Then after that, you should know, let's say disposal of PPE. Okay. Then you should also know there are two more things you should actually know. Asset carried at revaluation deficit now revalue upward. Sorry, assets carried at revaluation surplus. Now revalued downward. Okay, what is that saying? Then assets carried at revaluation deficit now revalued upward. Okay. All right. So this one will give you an idea of what PP is all about. Okay. So remember, it's an intensive class. So now PP. So let's start from the meaning. So let me see if I can run through all of this. Okay. So next class, I'll now pick a question on them. On some key areas around PPE, and then you can also quickly take a look at IAS40 and IAS38. Okay. Now, property, plant, and equipment. Now, listen. So it's a property. It could be land, it could be building. All right. Plant, machinery, your generating set, solar, inverter. Okay. Then equipment, maybe computer. Right. AC, air conditions. Right. So that's what we call property, plant, and equipment. Then when you have any of this and you use them for administrative purpose or in production of goods or services, that is IAS16, property, plant, and equipment. Is that okay? So that's IAS16. If you hold those assets for sale in the ordinary course of business, that is IAS2, inventory. All right. If you own land or building or part of land or building separately to earn rental income or for capital appreciation, that is property, investment property. You need to understand. So once I use property or plant or machinery in production of goods or services or for administrative purpose, that is PPE. Okay. Cost of PPE. There are three costs of PPE. And the examiner can pick you up on that. Okay. Number one, purchase price. So if I go to the market, I go to Computer Village and I buy a laptop. Laptop is a computer equipment and it is PPE, right? The amount I pay to buy, it is the purchase price. If they give me discount, I will remove it because I did not pay for that. They reduce the purchase price for me, right? That is purchase price. So it will be part of the cost of PPE. Or I went to Mikano to buy a generating set, right? That generating set, the price I paid is the purchase price. Then number two, directly attributable costs. Okay, direct costs. Okay, or directly attributable costs. What is this saying? The cost you incur in bringing the asset to its present location and condition as intended by management, or capable in operating as intended by management. Any other cost you incur, all right, it is what we call directly attributable cost. So after buying a mechanical generator, I paid for handling costs. They have to handle it for me, okay? It is part of the cost of PPE. Installation, when I take it to my center or my house or my company, I incur some installation costs. But before I buy it, I paid professional fee, okay? I consulted an engineer and I paid it. I will also capitalize it. Professional fee, okay? Sometimes borrowing costs can also be part of it, especially if I borrow money, just like we saw under IAS23 shortly. Then testing costs. What does that mean? When they install, they need to test to be sure that it is working well. In fact, if they buy fuel, maybe diesel or something, that what's it called? The money they are spent in for that diesel, okay, it's going to be capitalized at that moment, okay, because it's part of the direct attributable cost in bringing the asset to the present location and condition. So sometimes the examiner can ask you, list 6 directly attributable costs of PPE. This is what you said the examiner: handling cost, installation cost, professional fee, borrowing cost, testing cost, in fact, sometimes delivery cost. It's in your notes. So go and learn it, okay? So if he asks you, meanwhile, after the asset is ready for its intended use or sale, any other cost to be expensed, okay? For example, you now going to buy subsequent diesel or change the oil and all of that, then it's going to be expensed. Then number three, why am I using black? It should have been red, okay? Number 3, so I change it to red, okay? Cost of dismantling the asset, cost of dismantling or removing the asset, if you have an obligation to do so. I made mention of this when I took IAS37. Have you done IAS37? I think we should have done it, okay? Have we done it? Yes, I think so, yeah. Okay, so I think I also mentioned it. So when you have an obligation to remove the asset at the end of its useful life, you also add the cost of removing the asset. Remember, it will be in the future, and you discount to present value, and you take it as part of the cost of the asset. So these are the 3 costs of PPE, and you need to learn that right away. The examiner can pick you up on that. What are the excluded costs of PPE? Unfortunately for me, I don't have here to write again. What does that mean? Any cost you incur and it is not cost of PPE, that means it will be expense. For example, cost of opening a new facility. There are 4 of them. Okay, cost of opening a new facility. 2, cost of doing new business in a new location. Okay, they are also part of the cost that you expense. Okay, cost of opening a new facility, cost of doing a new business in a new location with a new customer, then administrative costs. All those ones, they are cost of, they are to be expensed. You can never capitalize them. So you need to understand that you can never, capitalize them, okay? You can never capitalize them. So when you have cost of opening a new facility, or cost of introducing a new business or a new product, or cost of conducting business in a new location, okay, or the administrative costs, they are excluded cost of PPE. So those are 4. Now, what is subsequent expenditure? Okay, I told you that after all these 3 costs, then you cannot capitalize again, especially when the asset is ready for its intended use. But sometimes, after that, there are some costs that when you incur them, you will capitalize them, even though you have been using the asset, okay? What does it mean to capitalize? So add it as part of the cost of the asset. That's meaning of capitalization. So what is subsequent expenditure? If any of these 3 happens, there are 3. For example, if I incur a cost on the machinery, and it's going to enhance the economic life of that particular machinery, then I can capitalize. What does that mean? That means it will increase the useful life of the asset. It will enhance the economic life of that asset. Then number two, if it relates to an overhaul or is required by major inspection, okay? If it relates to overhaul or is required by major inspection, that one normally happens around airline, okay? For example, by law, you need to overhaul a particular aircraft or a part of a particular aircraft. For example, maybe you overhaul your machinery or you overhaul your car, okay? You know, when you do that, most likely it looks like a brand new car or brand new equipment. So in that case, the money you spent, you can decide to capitalize. And number three, if it relates to replacing a major component of a complex asset, okay? When you are replacing a component of a complex asset, that's what they call componentization. For example, when you look at aircraft itself can have a useful life of 50 years, but there are some other components in the aircraft that have that are depreciated separately from the entire from the entire aircraft. You know, for example, landing gear and all of that. Okay, so in that case, that is a component of a complex asset. So when you are replacing them, you can decide to capitalize because they are depreciated separately from the entire aircraft. So that's it. If any of those three has not happened, it cannot capitalize. So it's either it will enhance the economic life of that asset, or it relates to a major an overall major inspection, or it relates to replacing a component of a complex asset. If any of that three has happened, that cost can be capitalized. Then you go to recognition criteria. What is that? Before I can recognize PPE on my account, initial the three conditions have to be met. It must meet the definition of an asset. It must be probable that economic benefits will flow, and the cost can be measured reliably. Okay, I think I would like to stop here. I don't want to rush this because whether you like it or not, you're going to see either two of that three in your exam. Either IAS16, IAS40, or IAS38. You will see two of them. I can bet it with you. You're going to see. Last diet, IAS38 came out. So most likely you have seen IAS16 and the IAS40 this time around. Although we still do IAS38, that's why it came out last time. Okay. So I don't want to rush it. So in our next class, I will start with measurement criteria. And we look at initial measurements and subsequent measurement. So what do you do around them? Then I will explain disposal, then asset, carried evaluation, and all of that. So we can play with one or two questions before I go to the other standards. So thank you so much. Thank you so much for being with me, or I'm being with FCA. So I'm going to see you, this time, same time next week by God's grace. So there's no question for me. I do hope you enjoy the class. Take some time to watch the video again. You see IAS20 on this video, you see IAS23 and a bit of IAS16. So thank you so much, my host. Thank you very much. Have a very wonderful night rest. Thank you. Take care. Bye.